Welcome to Looking at the Markets with David Moadel. Today is a special day here at Looking at the Markets. We have Mr. Rick Rule, the man himself, and he's giving us both video and audio today. And looks like, are you in your home office right now, sir?
No, my office. I have an office in Vancouver, BC, and an office down here. But no, this is, although informal, this is what a California office looks like.
Well, you're very generous to let us into your world a little bit and to give us some of your time, because I know you're a busy man. Mr. Rick Rule, just a quick introduction, is the CEO and president of Sprott U.S. Holdings. And you have a highly skilled team over there. Now Sprott is made up of three separate companies. Sprott Global Resource Investments, which is a registered broker-dealer with FINRA. Sprott Asset Management USA, which offers managed accounts, as well as Resource Capital Investment Corp., an SEC-registered investment advisor, which manages partnerships. Did I get all that right today, sir?
That's correct. The U.S. business. Of course, we have other business operations in Canada and around the world, but you've described the U.S. business well. Thank you.
Oh, well, I get it right once in a while. Of course, Mr. Rule is behind Sprott Global, and Sprott has two T's, SprottGlobal.com. And of course, I'll give you plenty of time to talk about the services therein and what people will see when they visit that website. But for right now, if I could just get a quick version of your financial background. How did you get started in finance?
I have been interested in natural resource investments, which is what I do now, virtually my whole life. I emigrated from the United States to Canada in 1970 to pursue a degree in natural resource finance at the University of British Columbia, part of the Commerce faculty. I have been involved in natural resource-based investing since then, that is, since the mid-70s. I started my own financial services business in 1990. That business was highly successful in the United States, and I sold that business to Sprott for stock. I'm the second largest shareholder of Sprott in 2011. Sprott was and is a Canadian domiciled and listed financial services company that is primarily known for precious metals and natural resource investing worldwide.
Fantastic. I appreciate that, sir. So let's skip over to the present time. Something about this market just makes me feel like it's very toppy. It has gone up so much, so fast, very recently. What are equities going to look like in your estimation for the rest of this year?
Well, with the caveat that I'm not an economist, I'm only a credit analyst. I suspect that you're correct in that the markets have come an awful long way, and it is alleged that they've come a long way on the Trump narrative, the supposition that the combination of infrastructure spending, a tax cut, and deregulation will drive economic conditions in the near term. My own experience with politics and the market going back 40 years is that if anybody expects any progress out of Washington in the near term, irrespective of the president, that they are usually disappointed. So my suspicion, given that some of Trump's policies are attractive, but given that he would appear to be picking 50 fights simultaneously, that his ability to win on those three issues, deregulation, a tax cut, or infrastructure spending, in the near term, appears doubtful. And so my suspicion is that if that is why the market is strong, that the market is in for some disappointment. Make no mistake, the companies that occupy the S&P 500, the large cap companies in the United States, are by and large world-class companies, and they are operating in an economy that, while it's not as healthy as it was 15 years ago, is still healthier than many competitive economies. So that doesn't suggest that this is a collection of bad companies. Great balance sheets, great income statements, great margins, great competitive advantages. But one needs to decide if their prices accurately discount the business conditions that we'll see in the future, or rather, if there is there some hype in the narrative, and is part of their market capitalization due to extraordinarily low interest rates that might change in the future. I would advise people who are invested in the broad market that if they don't have an extremely long-term perspective, that is a decade-long perspective, that they begin to be concerned about the level of general equities pricing.
That's great advice. Yeah, while we're not necessarily calling tops, because top calling is not always the way to go, we are exercising caution, it sounds like. But the question then would be, how do we do that? For example, should I dump equities and go into gold, silver? And if I do go into commodities such as gold and silver, do you recommend ETFs such as SLV, GLD, or should I get the physical stuff?
The nice thing about owning gold in particular, at least if you own it from my point of view, is that you don't own it necessarily to make money. You own it as an insurance policy. Gold has functioned for at least 2,000 years as a medium of exchange, that is a form of money, but at the same time a store of value. Other forms of money, dollar bills as an example, are really promises to pay, but gold is payment even in and of itself. So you own it, I think, if you own it correctly, as a very conservative investment. You own it the same way you own insurance. And if you think about it, David, you don't really want to get paid off on any insurance policy. A life insurance policy, the payoff assumes someone dies. Automobile insurance assumes that you got in a wreck. Homeowners insurance assumes that somebody broke into your house or it burned down. Similarly, owning gold is insurance, in my point of view, against social and political disruption. So you don't want to sell all of your other assets and go 100% in gold, the same way that you wouldn't want to invest 100% of your money in term life, where the payoff comes only after you die. Mercifully, in gold, when bad events happen, the gold price is so dramatically responsive that a fairly small insurance policy can accommodate a large variety of needs. So my own suspicion is that most of your subscribers would be very well advised to have 10% of their portfolio in precious metals, but probably no more than 25% of their portfolio in precious metals. And the size of the portfolio positioning would depend on what the other assets were. As an example, a viewer of yours who had most of his or her money in long-term bonds, where the impact of inflation would be particularly pernicious, would be well advised to have a greater percentage of their net worth in gold than somebody who, as an example, had an intelligently constructed real estate portfolio with moderate leverage, which allowed them to participate in inflationary pressures. So there is no one size fits all. With regards to the second part of your question, that is how one holds gold, that's really a matter of individual preference. My own advice is that if people hold physical precious metals, that they do not hold it at home. We laughingly call that midnight gardening. And having large exposure to something valuable in your house invites a different type of risk, visits from people who you normally wouldn't want to have over for lunch. In terms of certificated gold, the choices between the ETFs and products like the Sprott Physical Gold, Silver, and Platinum and Palladium Trusts are very clear. For U.S. shareholders in taxable accounts, that is not in IRAs or 401ks, the trust form of certificated ownership is the best. That's because the IRS regards ETFs as gold surrogates, and the holder is taxed on capital gains, if any, at their ordinary income rate rather than at the capital gains rate. So holding gold, if you're going to own it in non-physical, in certificated form, the best products available are the trusts, simply because of taxation. Other people favor the trusts over the ETFs simply because the structure of the physical trust means, because there is no buying and selling of gold in a consistent basis from the trust, that the trust never runs the risk of being an unsecured creditor of a third party in the event of a financial crisis. There has been criticisms of the ETFs because they shrink and swell every day due to inflows and outflows of investor capital, that the possibility exists that in a liquidity crisis like we experienced in 2008, that some aspects of the inventory of the ETFs could be delivery receipts rather than physical metal, and the holders would be exposed to third-party credit risk. So in that context too, I think investors that want to hold certificated precious metals would be better advised holding it in the trusts. And of course, the trusts that I hold mine in are the Sprott Physical Gold Trust, the Sprott Physical Silver Trust, and the Sprott Physical Platinum and Palladium Trust.
Those sound fantastic. Now, if somebody wanted to get more information on those particular trusts, as well as the other services offered by Sprott U.S. Holdings, should they go to the website sprottglobal.com? What's the best way to do that?
Yeah, I think sprottglobal.com is probably the best place for them to come, where you'll have information on all of the Sprott products and services.
And what would some of the other, besides the gold trust, silver trust, so on and so forth, what are the other services that might be offered?
Well, one of the things that might be very useful to your subscribers is that our site has about 200 hours of free educational material on it. An example would be that we have 50 hours that I taped in conjunction with the Colorado School of Mines. This was a distance learning project that the Colorado School of Mines did and sold for $1,000 a copy. I later bought the product from them for $1, and I loaded it as freeware on our site. So there's literally 200 hours of educational material on our site about gold and precious metals, about mining stocks, about natural resource investing generally. It's a wonderful place for somebody who is interested in commodity-centric investments, but is uncomfortable with their own lack of knowledge, to develop the knowledge necessary to succeed in the market. And importantly, it's free.
That's fantastic. I don't see why people wouldn't take advantage of that, and that's on sprottglobal.com. And I don't see why people wouldn't want to tap into that free knowledge that you're sounds like you're creating a fantastic public service for people, and that's highly appreciated. Now I'm looking at a video of yours, which I saw, which really got my attention. It says, "Always buy a stock for a reason, sell it if it disappears." What does that mean, and is that part of the philosophy at Sprott Global?
It absolutely is. A lot of the work that we do is on small cap natural resources stocks, companies with market capitalizations less than $1 billion, often companies with market capitalizations less than $100 million. It's important to know that in resource speculation, the exploration function, that is the earliest stage companies, function very much the way research and development companies function in technology. That is, they aren't asset-intensive businesses. They're actually human. They're process companies. They're really research and development companies. And what that means is that the companies add value by answering unanswered questions around their key thesis. In technology, it might be a molecule that they believe is efficacious for fighting some disease. In software, it might be an algorithm which is useful for some economic function. And in exploration, it's a thesis around the potential economic value of a mineral deposit. So when I say that you buy a stock for a reason, it's because you understand the thesis that's being proposed, the unanswered question. You know something about the probability of success, you know something about the size, the value of a yes answer, and you know something about the process involved in answering the unanswered question. If you are proceeding towards getting an answer of that unanswered question, and the answer comes back no, the reason to own that stock is gone. If you aren't going to get a yes answer, you aren't going to get the value out of it attributable to a yes answer, and you must sell. If you bought the stock for $1 and the stock is trading at 70 cents, but you get a no answer, it's better to lose 30 cents than it is to lose 50 cents. And that is true across technology, across any other business that is really an intellectual property. rather than a physical assets business. Many, many times, people have transferred in laundry lists of securities to me that they've held for years and years and years. And one of the things that I do is I offer a no obligation review of people's natural resource portfolios to get them started. And very often, you know, I'm starting at the top of their list, so it's an A, amalgamated aardvark or something. And you know, the client will say, "What do you think of it?" And I'll say, "Well, why do you own it?" "Well, I own it because so-and-so recommended it 10 years ago." "Well, the guy's out of the business. Why do you own it now?" "Well, I don't know." "Well, then you should sell it." They say, "No, I can't sell it." "Why?" I say, "I paid $4 for it, and now it's selling for $1. And if I sell it, I'll lose $3. And I have to explain patiently, "No, you've already lost $3. The question is, what will you do with the dollar that remains?" It's important that you hold your portfolio in the context, not so much of the share price, but rather in the context of the value represented by the still unanswered question in the company. When you begin to have reasons to own stocks and pay attention to the reasons, you will begin to trade your portfolio successfully.
Totally agree. And there's another free, amazing service, a portfolio review from Mr. Rick Rule. People should definitely take advantage of that. I don't see why they wouldn't. And also, Mr. Rick Rule, I just wanted to, I know your time is important. Want to talk about oil. You know, I remember oil was above $100 a barrel for a long time, came down to about $27 a barrel. Boy, I wish I'd bought then, huh? And now it's hovering at around $48 a barrel. What are we looking at in the medium to long term, do you think?
Again, with the caveat that I'm not an economist, I'm a credit analyst. So this is what I think as opposed to what will definitely happen.
Sure.
I think in the near term, the oil price is going to be reasonably soft for two reasons. One is a lack of global demand for anything. It doesn't seem like there is any broad-based economic recovery going on anywhere in the world, including the United States, although our economy is stronger than other developed economies. In the absence of a demand increase, you need to deal with market imbalances by supply destruction. And in the very near term, there is more oil trying to crowd into world markets than there are consumers for them. Although OPEC is attempting to rig the market, in my experience, the probability that the Iranians and the Saudis, who despise each other, and the Russians, who aren't on good terms with either of them, the idea that they will cooperate to manage a market appears to be a non-starter. At the same time, more Iraqi crude is trying to get into the market, and soon more Libyan crude will try and get into the market. So in the near term, I think oil markets are soft. In the longer term, if we look at perhaps 2 years, a different situation takes over. There's two ways a market recovers. One is through demand creation, where either economic growth or the utility offered up by a very cheap product increases demand for the product. The other way out of a bear market is through supply destruction, and that's happening in the oil markets as we speak. The International Energy Agency has said that it costs about $60 a barrel worldwide to make a barrel of oil. Now, that isn't just the lifting cost. That's the exploration cost, the general and administrative cost, and in particular, the cost of capital. So right now, the industry is making the stuff for 60, and they're selling it for 48. They're losing $12 a barrel, 97 million times a day. This is sustainable for a little while because the industry became so overcapitalized in 10 good years. But at some point in time, either the oil price goes up or there won't be oil available. If you ask yourself whether or not the price will be the price of oil will be over the total cost of production in the 5 or 6 year time frame, the equivalent is asking yourself whether your car will start in 5 or 6 years. Because if the price isn't over 60, your car won't start because there won't be oil for it. What I guess I'm saying is soft in the near term, strong in the long term.
Gotcha. And this is actionable. Again, we're not telling people what to buy or what to sell. but sounds like actionable ideas right there, and we definitely appreciate that insight. Just to go over it one more time, what are some ways people can contact you if they want to tap into your knowledge and insight?
The easiest way probably to get started with us, just to see if we earn our keep, is for your subscribers who are natural resource investors and speculators. If they want to email me a copy of their resource portfolio, and understand I want it in text, not as an attachment, because I'm not skilled enough to open 15 different kinds of attachments. Mm-hmm. But if you send me a text that has the name of your resource companies and the symbol of your resource companies, I will rank those companies and return that text to you on an absolutely no obligation basis. You can send that to me at contact@sprottglobal.com, SPROTTGLOBAL.com. I also would encourage your subscribers to go to the website, www.sprottglobal.com. As I say, there's 200 hours of instructional material there absolutely for free. When you're at the website, click on the tab that says Sprott's Thoughts. Sprott's Thoughts is a weekly blog by the best minds that the Sprott organization has access to, both within and also outside the organization. I guarantee your listeners will get their money's worth because it's absolutely free.
Yeah, that's fantastic. I'm looking at the bios of the people on your team right now, and these look like the best and the brightest in the business. So I can't imagine people would not, at the very least, contact you and avail themselves of these opportunities. All those hours of free educational resources, and you're offering to rank, if you will, their holdings. That's great. That's a great public service, and again, this is a public service too, because you're answering people's questions and probably saving them from imminent disaster, possibly. So, very much appreciated. And speaking of appreciation, thank you so much, Mr. Rule, for your time today and all of your insights. I cannot wait to upload this to YouTube and post it for everybody to see. So thank you so much for allowing us into your world for a few minutes, sir.
It's my pleasure. Thank you much. I look forward to another opportunity to address your audience. Thank you.
Thanks a lot, Mr. Rule. Appreciate it today.